Hi everyone, thanks for tuning into my channel, All Things Accounting. Today we will be dealing with inventory costing methods, in particular three types of methods. I'll be breaking this up into a three-part series, so I'll be examining each method one by one. So stay right there and we'll get through this together. So inventory costing methods, there are three types that we can look at. There's the weighted average, then there's what is called the FIFO, which is first in, first out, and then LIFO, last in and first out. So I'll break this up. We'll deal just particularly in this video today with the weighted average. So we'll go through a numerical example together. So for weighted average, there's a certain computation for it. If we know that under the periodic inventory system, we need to calculate the ending balance inventory through usually an inventory account. If we get that figure wrong, then that means so too will our cost of goods sold figure and therefore the net income figure as well. So it's important that we pick the most appropriate methodology, get our inventory count as accurate as possible as well, so that it can be accurately reflected upon the financial statements. So let's go through an example here. Let's say on February 4th, ABC company, let's say that they bought 200 units of a particular widget or whatever at $1 a piece. So that would yield $200 worth of inventory there. Now let's say on October 13th, ABC company also bought an additional 100 units. Actually, let's make this 200 units at $1.50. That would give us $300. Now, if throughout the year, they're assuming that their sales were even throughout the year, and in the first year, if they sell 200 units, well, the question now becomes which ones? Is it the 200 that they sold, that they purchased at $1 each, or is it the 200 units that they sold that was purchased at $1.50? Or maybe it could have been a combination of the both. So that's where the question comes in, because again, this has an important impact on our computation of ending balance inventory and therefore their cost of goods sold and ultimately the impact on the net income and therefore the financial statements. So for the weighted average method, I will be putting down some details here just to help us through the weighted average, the FIFO, and the LIFO in the other tutorials as well. So let's say that here, let's establish that we have an opening balance, and let's say that this is units, number of units. This is going to be the unit cost, and over here is the total cost. All right, so let's say that we have 500 units in opening balance valued at $10 each. Therefore, that will give us $5,000. Throughout the year, let's say on January 20th, we purchased an additional 300 units at $11. So that will give us $3,300. On April 8th, we purchased an additional 400 units at $12 a unit. Therefore, that would yield $4,800. And then on September 5th, we purchased an additional 200 units at $13. That gives us 2,600. And lastly, on December 12th, we purchased our last 100 units at $14. So that gives $1,400. Therefore, if we look at the total available, this is the total available for sale. So that would be in total 1,500 units. And over here, the dollar value would end up at $17,100. Let's say throughout the year we sold, our selling figure is that we sold 900 units. Now, our ending balance, therefore, would be the difference between this. So our ending balance would be 600. That's still in our account. So if we were to look at the weighted average, the weighted average method assigns the cost, the same unit cost, to all units that are available for sale. So if we look at this, the cost, the way we calculate this is the cost of goods available for sale divided by the units, the number of units available for sale. And that would give us our weighted average cost. So if we were to use this, our cost of goods available for sale, which would be 17,100 divided by the total, which is 1,500, that would give us $11.40 per unit on average. So if we were to therefore calculate our ending balance inventory, knowing that our ending balance inventory is 600, so that would be $600 multiplied by $11.40 per unit. That would give us $6,840. And therefore, our cost of goods sold would be equal to our available, which is 17,100 less our ending balance of 6,840, and that would yield approximately $10,260. Therefore, if we want to do the journal entry, would be debit cost of goods sold for $10,260 and credit our inventory of the same amount, and with an explanation of here. So that's the weighted average methodology of inventory costing. The next couple of tutorials I'll be doing would involve LIFO and FIFO. So I hope you found this tutorial to be very useful. Please subscribe to my channel, hit that like button and the bell notification icon so that you're always up to date on the new tutorials that I have to post. So until next time, take care.